Chapter 10, real estate closings. This chapter deals with the closings. Not a very long chapter, but I'm going to deal with prorations and everything. Now, buyer has certain requirements to close. What the buyer requires, there's a list of bullets over there. They want evidence of title. They want the seller's deed, any documents demonstrating the removal of undesirable liens or encumbrances. They want a copy of the survey, results of any required inspections, and if there's any leases on the premises. Final property inspection, you can highlight that. This is called a walkthrough. A day before the closing, we have a walkthrough. This is where the buyers walk through the property to make sure the property is in the same condition when they first saw it, less any ordinary wear and tear. Usually a walkthrough takes about 10, 15 minutes. They just want to make sure sellers didn't destroy anything. Spot survey, you can highlight that. Seller pays for a survey. Survey shows if there's any trespasses, any burdens attached to the property, any encumbrances. Now, seller has certain requirements to close. Actually, the seller has only one requirement to close. Was the buyer able to get funding? That's all the seller cares about. Was the buyer able to get the funding on a property? Now, let's go on to the next page. I think we might skip that page. Let me just see. Yep, I'm going to skip that page. Let's go to the next page. This is called closing procedures. Let me just check something. Okay, 183. Face-to-face closing. Now, they call this a face-to-face closing because this is generally when the buyer and the seller meet each other for the very first time. They meet each other at the face-to-face closing across the table from each other. Now, because of COVID, they're not doing face-to-face closing. What they're doing, both the buyer and the seller and the real estate agents are sitting in the parking lot in their cars, in their own cars, while only the lawyers go to the title company to avoid that. But usually what happens at the closing, usually you have the closing officer, and she's sitting at the head of the table. Usually on the right, they got the seller's attorney. Next to the seller's attorney, they got the sellers. On the right, they got the buyer's attorney. Next to the buyer's attorney, they have the buyers. And agents are sitting at that table as well. That's usually what it is. Now, after the bullets, we have closing agent or closing officer. There's one person that conducts the entire process of the closing, and she's the one that's sitting at the head table. And let me tell you something. I've been to a lot of closings. I mean, well over 1,500, maybe close to 2,000 closings, I'm guessing. And I understand a lot that goes on in the closing, but I am amazed by a closing officer. If you ever been to a closing, for an hour and a half, you got these papers being shifted back and forth between all the parties. They wind up in one big pile in the middle, and she just kind of thumbs through that. And just, I mean, in seconds, she says, you know what? I'm missing my water certification. I'm missing an affidavit. I've been to a lot of closings. I understand what goes on there. I cannot believe how those people really, really know their business. And I have seen closing officers doing 2 or 3 closings at the same time. They're running from room to room to room, making sure everything balances down to the very penny. I just have so much respect for those closing officers. They are rock stars. I do believe that. I don't think I ever ran where they were crabby. I haven't. I mean, and I've been to many closings. You know, I do respect them for what they do. I don't know if they're crabby. I don't know. I haven't experienced it. I imagine they can be. So, okay, then the next paragraph you can highlight: the closing agent orders and reviews the title insurance policy, make sure everything is proper, everything is they own it, they have the right to sell, all that stuff. And then the exchange is made. The deed is given to the buyer, the keys given to the buyer, the title report to the buyer, seller gets the money. Now, closing and escrow. You got to highlight that one. Occasionally you'll see that. Closing and escrow, you can put a X by that one too. Now, sometimes what happens, they might be missing a document. Maybe the money wasn't wire transfer. Maybe they're missing a zoning cert or something like that. So what happens, all the documents are signed and they're deposited or placed with the closing officer. And usually it's cleared up within a day. Then the next day, whenever they get this document they were missing, then the closing officer would distribute the paperwork and the checks and everything else. So that's how that works. We call it a dry closing. Closing and escrow, we call it a dry closing. Now, let's go on to page 185, about a quarter of the way down. Licensees role at the face-to-face closing. Well, actually, there's only one reason why a licensee shows up at the closing. That's to get their check, or the check that's made out to their sponsoring broker. Plus, they had to get a copy of all the closing documents because that's how the sponsoring broker can close out the file. So they get the check and the closing document so they can bring it over to their sponsoring broker right away so their sponsoring broker can cut out their commission check. So that's the only reason why an agent shows up at the closing. Now, agents say, no, no, no. I go there to support my client, make sure everything goes smoothly. Nope, they're lying. They only go there for the check. As I said, I've been into well over 1,500 closings. And let me tell you why I go to all my closings. It's to get my check. That's it. I'm going to be the only honest one with you. I will tell you that. There's a question here. Ah, your agent came to get their bottle of John Julio. Okay. Money is a great motivator. Absolutely right. I'm going to come and get my Don Julio too. I'll be over. So, okay, let's go on to this other stuff. You could read the rest of this. Yeah, thank you very much, Rebecca, for saying that. Rebecca, don't forget to stick around so I could go over that property tax things with you today. Okay, this other stuff you can read on this one on page 185. Let's go to page 186. Let's talk about halfway down the Real Estate Settlement Procedure Act. This is called RESPA. Now, Real Estate Settlement Procedure Act, whenever there's a financial institution involved with the closing, involving a sale of residential property, then there must be a RESPA form. Now, the settlement documents or the RESPA form is the very last document signed by both the buyer and the seller. It's about 4 pages long. It goes through all the expenses and the prorations, which I'm going to talk about some of them. It goes through all the expenses. It will state how much money the seller is going to net out, how much money the buyer needs to come in with. All that's going to be part of it. So, let's go on to RESPA. On top of page 187, there should be 3 bullets. Yep, 3 bullets. I like you to highlight those, put X by it. Now you don't have to remember any of these section numbers, but Section 8 prohibits any type of kickbacks and fee splitting for referrals or settlement services, unearned fees that are not actually performed. The second bullet, Section 9, and you don't have to memorize these, but well, let me explain what a kickback is first of all before I go on to Section 9. You're a buyer, and I refer you to use this particular lender. The lender's going to give me $100 kickback by me referring that business to them. Kickbacks are allowed Long as they're not charged back to the client and they're not paid directly to the broker, they have to go to the sponsoring broker first. Now, the next bullet, section 9, prohibits home sellers from requiring that home buyers buy title insurance from a particular company. And then the third bullet prohibits lenders from requiring excessive escrow account deposits, like for taxes and insurance. It has to be reasonable. They can't go and say, I want a year and a half, your credit's not that good, or you're a certain minority, so we want a year and a half worth of taxes set aside. No, they can't do that. They have to treat everyone exactly the same. Now, they talk about a good faith estimate, which I'm going to come to in a moment. Now, the last paragraph of this page, they talk about special information booklet. Kickbacks are allowed. Yes, costs. Kickbacks are allowed as long as you disclose it to the client in writing. It's not charged back to the client, and it goes to the sponsoring broker before it goes to you. Do agents take kickbacks, you think? Yeah, they do. Do they disclose it to their clients? No. Is it paid to their sponsoring broker before it goes to them? No. No, it's not. Well, I'll tell you this, I don't take kickbacks. I've never taken a kickback. And I want to tell you why. I give my business to people that are going to get the job done, to the loan officers, to the home inspectors, to the attorneys to get the job done. You know, they're going to pay you $50 or $40 or $100. What am I going to do with that? You know, I could walk around the corner and spend that. What I'm looking to make is $6,000, $7,000, $8,000 when that transaction closes. That's why I give my business to these people. So, my one of my best friends is a real estate attorney. I've known him over got to be about probably about, I would say, close to 40 years. He's been a lawyer for over 30 years, and I give him a lot of business because he's very, very good. He does a lot of all my legal stuff, and when he does my legal stuff, I pay my attorney. He says, Sam, you don't have to pay me because you give me so much business. Nope, I'm paying him, and I tell you why. In case I have a problem, he's going to take care of that problem. That's why. Plus, he owns real estate, and I buy and sell real estate. He uses me as his agent. So guess what? I charge him a commission. Business is business. I've known him for a long time. I've known him almost 40 years. We've been on vacation with our families, been to Italy several times, been all over. But business is business. Business is business. So I don't do that. I pay them. I don't take kickbacks. Now, special information booklet, this is put out by HUD. It kind of describes everything on the rest, but no one's ever read it. It's almost impossible to read. Believe me, I tried to. Now, good faith estimate on the top of the next page here. Now, good faith estimate tells you, good faith estimate saying you got $10,000 in earnest money. We're going to close in 6 weeks. How much additional money you need to come in with? All your closing costs, all that's going to be on a good faith estimate. Now, there are some things, there's no, see these next 3 bullets, I like you to highlight, put an X by them, be familiar with them. On a good faith estimate, this is when you apply for the loan, they have to give this to you within 3 days of applying for that loan. There's no tolerance. These fees cannot increase. And they include lenders' charges for taking, underwriting, processing the loan, which includes points, origination fees, and yield spread premiums. There is a 10% tolerance on fees. They cannot increase more than 10%. We're talking about settlement services from that the lender provides, and like the appraiser and things like that, and title services and title insurance cannot increase more than 10% of what they quote you. Then there's third bullet, unlimited tolerance, because they can't control this, what the taxes are going to be, what the homeowner's insurance is. They can't control that. So there's no tolerance on that, unlimited tolerance, I should say. So those are the 3 things I want you to be familiar with. Let's go on to the next page. Here it says kickbacks and referral fees again. RESPA prohibits any kickbacks or referral fees or unearned fees in any real estate settlement service. Again, can you take a kickback? The answer is yes, long as it's not charged to the client and it's paid to the sponsoring broker. And it has to be disclosed in writing. I want to use this lender. They're going to give me $100. Now, TRID. There's a new law called TRID. Truth in Lending Act, RESPA, Integrated Disclosure Rule, TRID law. Now, this is about 5 years old, this particular law. And they made some changes. Not that people really, I mean, they don't use these changes, but they're out there. Like, here's what I want to cover on this. First of all, it refers to any type of loan involving a mortgage. Now, there's new terminology I want you to be a little bit familiar with. Not that anyone really uses this, but the old terminology, a lender is now called a creditor. The borrower is now called the consumer. The closing or the settlement or the signing is called the consummation. And then the tolerances are now called variances. So just occasionally they're going to throw a couple of those words into the exam, not too often. So now just the information needed to apply for the loan. And then they have the loan estimate right there. Regulation C, truth. The TRID law. I want to get that mixed up. Preparation of a closing statement. Like a highlight, put an X by that. A typical real estate transaction requires of the accounting for the expenses incurred by either party, which is usually on a HUD-1 form, that last document signed by everyone. All expenses must be itemized to arrive at exact amount of cash required from the buyer and the net proceeds to the seller. Now, how the closing statement works. The completion of a closing statement involves the accounting of the party's debits and credits. A debit is the amount that a party owes and must pay at closing. A credit is amount entered in a person's favor, amount that's already been paid, an amount being reimbursed, or amount the buyer promised to pay in the form of a loan. Now, these next two lines put X's by it. A debit is the amount to be paid by the buyer or the seller. A credit is amount payable to the buyer or the seller. Now, of course, on the closing statements, they have these, closing statements, the debits and credits. So let me give you an example. 1 second. There we go. Now, in a transaction, we have a buyer and we have a seller. We have debits. We have credits. Now, a debit to the buyer means this. It's going to cost them money. They have to go to the bank before the closing and bring more money to the closing. Whereas a credit to the buyer means that when they go to the bank to bring in the money to close the property, they have to bring in less money. It's more money to them. Now, to the seller, a debit to the seller means they're going to wind up with less money at the closing. A credit to the seller means they're going to wind up with more money. So let me make this real simple about debits and credits. Look, debits, they are bad. Credits are good. That's what you need to know. Now, I'm going to go over some of these fees here. I'm going to give you a couple of examples. I'm going to come back to that. Well, I could do that right now, exactly. Let me go over some of these. I mean, I'm going to go on to the next section, but, oh, I'm missing something. Sorry, I went too far. Hold on a second. Hold on. Oh, okay. It's after all this. So you gotta look over these forms. They're kind of confusing, but these are the things that you get. Don't worry about these too much. Let's go on to I got a lot of forms here. Okay, we'll go on to prorations. Now, before I get into prorations, I want to go over, give you a couple examples of certain things. Now, a the commission that's paid by the seller on the closing statement, the commission shows up as a debit to the seller. Doesn't mean anything to the buyer, the commission, if the seller pays for it. It's a debit to the seller. The purchase price of the property. The purchase price is a credit the seller, debit the buyer. That's what the purchase price is. It's credit the seller, debit the buyer. Now, these are just a couple of examples, a couple of things occasionally some of you will see. The earnest money that the buyer put up at the time that the offer is made, the earnest money shows up as a credit to the buyer because that's the money they already put up outside of closing when they made the offer on the property. It doesn't mean anything to the seller. The earnest money is a credit to the buyer. Now, this is one that a lot of people get confused on. The money the buyer receives at the closing from the bank, that's going to be turned over to the buyer, but the money they receive, the buyer receives at the closing, shows up as a credit to the buyer. They had to pay for it, that's a debit, but the money they receive that they turn over to the seller shows up as a credit to the buyer, just to let you know. Now, let's talk about prorations here. You can, if you want, highlight, put an X by the next 3 paragraphs. Now, most closings involve the financial responsibility between the buyer and the seller for such items as loan interest, taxes, rent, fuel, utility bills. These allowances are called prorations. Prorations are necessary to ensure that expenses are divided fairly between the seller and the buyer. Accrued items like water bills, taxes, interest on assumed mortgages that are paid in arrears are expenses be prorated, are owed by the seller, but later be paid by the buyer. Seller pays for these items by giving the buyer credits for them at the closing. Prepaid items like fuel, oil, and tanks, maybe condo assessments, are expenses to be prorated that have been prepaid by the seller, not fully used up. Therefore, they show up as credits to the seller. Now, let's skip down to after those 4 bullets where it says that one line by itself. Using this general principle, there are 2 methods of calculating prorations. Like you'd put an X just by that first bullet. The yearly charge is divided by 360-day year, and by 12 months, that has exactly 30 days in each month. Here's what you need to know on proration problems. There are only 360 days in a year. It's called a banker's year. Each month is called a statutory month. Each month contains exactly 30 days. January has 30 days. February has 30 days. Each and every single month has exactly 30 days. This is what you're going to use on all your proration problems, except for, unless, which is kind of rare, very rare, they ask you to use the actual number of days in a year. I have a question here. Let's see what it says. Can you repeat that? The money that the buyer receives at the closing from the lender. No. Yeah, the money that the buyer receives from the lender shows up as a credit to the buyer. That shows up as a credit to the buyer. He has to pay for it, and that's a debit. But the money they get, it shows up on a statement as a credit to the buyer. which is turned over to the seller. Okay, a lot of people get mixed up on that one. Now, I want to do a couple of proration problems. Now, what you need to know about prorations, that we're going to use the 30-day statutory month. Each and every month has 30 days. Now, the day of closing, the seller is responsible for the day of closing. The day of moving, the tenant is responsible all the way, including the day of moving. So let me give you a couple problems, okay? Now, the real estate taxes are $7,200 a year. They were paid from 1/1/2018 to 12/31/2018. Even though I put 31 days in there, there's 30 days in each and every month. Our closing occurred on April 18th, 2019. So the taxes were paid to the end of 2018. Nothing has been paid in 2019. Now, who's going to owe for the taxes? Does the buyer owe the seller or the seller owes the buyer? Which one? We're closing on April 18th, 2019. Seller owes the buyer for the taxes or the buyer owes the seller? Correct. Seller owes the buyer. Seller owes the buyer for taxes. Now, here's another question. How many months and how many days does the seller owe the buyer for? How many months and how many days does the seller owe the buyer for? We're closing on April 18th. Nothing has been paid in 2019. How many months and how many days does the seller owe the buyer for? The day of closing, the seller is responsible for the day of closing. The day of moving, the tenant's responsible for that day. So, how many months and how many days does the seller owe the buyer for? Now, most of you got it right, but a couple of you put down 4 months and 18 days. It's not 4 months and 18 days. It's 3 months and 18 days. 3 months and 18 days. January, February, March. The end of March is 3 full months. We're only 18 days into April. Most of you got it right, but a couple of you got it wrong. Don't worry about that. Just as long as you don't make the same mistake. Because on the state exam, they're going to have you calculate the prorations for 4 months and 18 days, which if you did, you're going to find an answer. It's going to be wrong. So let me show you how we're going to solve this problem. So the taxes are $7,200 a year. Sorry about that. $7,200 a year. Divide this by 12 months. Comes out to $600 per month. Now, January, February, March. Multiply this by 3 months. January, February, March. gives me $1,800. That takes care of January, February, and March. And now I had to figure out the 18 days of April. Well, it's 600 a month divided by 30 days equals $20 a day. $20 a day times 18 days comes out to $360. Now, if you're not clear on any of this, you let me know and I'll explain it again. But we add the 18 days of $360 to the 1,800, which gives us $2,160. And this is what the seller owes the buyer for. Now, I'm going to give you another proration problem, a different one. But before I go any further, I want to make sure that everyone is clear on this. If you're not clear, I'll be more than happy to go over this again. I just want to make sure all of you understand this. Oh, okay. Someone says you want more time to figure this out. All right, I will let you do that. I will give you more time to figure this out because it'd be better that you do learn it on your own. So, but before I go on, I'll let you figure out the next problem. Before I go on, anybody have any questions or not clear on this particular problem here? Then let me give you another problem. Okay, here's your next problem. The 600 came from it's $600 a month. So on seller owes for the day of closing, 600. Let me go back to this problem because there's a couple questions. Yeah, I'll repeat. The seller is responsible and has to pay for the day of closing, and the tenant is responsible or has to pay rent to the day they move out. All right. So let me scroll all the way down. The taxes are $7,200 a year. They were paid to the end of 2018. Nothing has been paid in 2019. We closed it on April 18th, which is 3 months, January, February, March, 3 months, plus 18 days of April. $7,200 a year divided by 12 months in a year equals $600 a month times 3 months. January, February, March is $1,800. That takes care of January, February, March. Now I need the 18 days of April. $600. I got this number, 600. I got that from here. $600 a month divided by 30 days comes out to $20 per day. Times 18 days is 360. So this 1,800 is January, February, March, and then the 18 days of April. And who owes for that? Well, the seller owes the buyer. Okay. Just want to make sure all of you are clear on that. Another few more questions. Okay, I did that for you. Can you explain the arrears again? The arrears, we are, okay. If you bought a property today, September 21st, you close today, the taxes for 2020 is not going to be due to June 1st and September 1st of 2021. Now, the new buyer, the seller has occupied this property. We're 1 year behind. They're going to prorate that. That's what I was doing right now. Taxes are paid 1 year behind, but when you get this problem here, you go by what the problem says. And what I did say that the taxes were paid till the end of 2018. So we didn't have to worry about the taxes being in arrears, not with these problems here. So don't think about that when you have proration problems. Okay. Now, let me give you a problem and I'll give you time to solve this. Just let me check something out. Okay. Let's do it this way. Now, the rent is $930 a month. On October 1st, the landlord went to pick up the rent for the month of October. But the tenant says, look, I'm moving out and I'm leaving on October 22nd. Landlord said, that's okay. Just pay me for the days you're going to be here. Question is, how much rent did the landlord collect? So I'll give you time to figure it out. Let me repeat it. Your rent is $930 per month. On October 1st, the landlord went to pick up the rent for the month of October. The tenant says, look, I'm leaving on October 22nd. Landlord said, that's okay. Just pay me to the 22nd, just for the time you're going to be here. Question is, how much money did the landlord collect? I'll give you a moment. Go ahead and figure it out. Okay. I can give you another moment. I expect everyone to answer these questions when I ask them. They're very important. I can verify that you're here, not watching TV too. Okay, the seller is responsible. I mean, the tenant is responsible to the day they move out. They're not moving out to the 22nd. Seller's responsible to the day they move out. So the answer is $682. Oops, how come? There we go. Now, here's how we solve this problem. $930 divided by the 30 days of October. Why? Every month has 30 days. Every month has 30 days, including October. I guess we have no Halloween in prorations, which comes out to $31 a day times 22 days equals 682. If you use 31 days to figure out this problem, wrong answer. Wrong answer. Every month has 30 days. This is what you need to use on all proration problems. Okay. Okay, anybody have any questions on this particular problem? It's okay. Just want to make sure everyone understands it. All right. And that's the end of this chapter. That's the end of chapter 10.